Hey everyone, and welcome to this explainer. Today, we are cracking open something called the Statement of Comprehensive Income. Now, I know, that sounds super formal, but whether you're an entrepreneur, an investor, or you're just tracking your favorite company's fundamentals, you probably already know this document is absolutely vital. By the time we wrap up here, we're going to completely reframe this thing. We'll take it from a boring compliance document and turn it into your ultimate, everyday measuring stick for real business success.
Seriously, think about the everyday anxiety of running a new business. Imagine you finally launched your absolute dream company, right? Customers are walking through the door, the cash registers are ringing, and your bank account balance is just fluctuating wildly every single day. It's super exciting. But deep down, there's this gnawing question just keeping you up at night. Am I actually making money? You've got money coming in, sure, but you're also bleeding cash out to suppliers, to rent, to employees. Just glaring at your bank balance won't actually give you the true answer. Well, that is exactly where the Statement of Comprehensive Income comes in. It's the ultimate cure for that anxiety. It clears away the fog and shows you the undeniable truth about how your business is really doing. Okay, let's dive into our roadmap for today. We'll break down the math logically, step by step, so it's super easy to digest. We're going to cover 1. The business report card. 2. The financial building blocks. 3. Services versus selling goods. 4. The single-step approach. And 5. The multi-step approach.
Section 1. The Business Report Card. Let's look at the big picture of what this document actually represents. First things first, let's get our definition straight. The Statement of Comprehensive Income, which, by the way, you're going to hear referred to a lot as just the income statement, is a financial report showing a business's revenues, its expenses, and the resulting profit or loss. Now, the absolute key phrase I want you to lock into your memory right now is for a specific period. See, unlike a balance sheet, which just takes a quick snapshot of a company's financial health on one exact specific day, the Statement of Comprehensive Income actually measures performance over time. It looks at a whole month, a whole quarter, or a whole year to tell the complete story of what happened during that time frame. And honestly, the absolute best way to think about this is like a school report card. Back in the day, your report card didn't just tell you how smart you were on like a random Tuesday in November, right? It created how efficiently and effectively you performed over the entire term or semester. Well, the Statement of Comprehensive Income does exactly the same thing, just for a business. It takes all the money earned, subtracts all the money spent, and basically grades the business on its profitability and efficiency over that term. Did the business pass or fail this quarter? This document has the exact answer.
All right, moving on to Section 2, the financial building blocks. Let's zoom in from that macro view and look at the elemental pieces.
The crucial thing here is mastering these 3 foundational building blocks. I mean, every single income statement out there, no matter how massive the global corporation, is built on these exact elements. First up, you have your revenues. This is the income you earn directly from your main business operations, selling products or providing services. Second, you have your expenses. These are the costs you inevitably rack up in order to earn those revenues. Think paying rent, buying materials, or employee salaries. And finally, you've got gains and losses. These are other financial impacts that definitely affect your bottom line, but they aren't part of your daily core business. Something like, say, selling off an old piece of company equipment. To really ground this, let's just map it to your basic household budget. Your monthly salary, that's your revenue. It's the primary money coming in. Your rent, groceries, your utility bills, those are your expenses, the costs of just living your life. Now imagine you finally clear out your garage and you sell an old couch on the internet for $100. That right there is a gain. It boosted your bottom line for the month. But, selling couches isn't your actual day job. Relating it back to this personal level just makes it so much easier to grasp exactly how businesses categorize their cash flow. Okay, Section 3, services versus selling goods. Let's look at how this changes based on the business type. Now, what's really interesting here is how the Statement of Comprehensive Income actually shifts its shape depending on the kind of business you're running. Let's say you have a service business, like a tutoring company. Their income statement is fairly straightforward. They focus on service revenue coming in from the students and operating expenses, like marketing and office supplies going out. But contrast that with a merchandising business, like a bookstore. This requires a much more detailed structure. Why? Well, because they have physical inventory. A bookstore has to account for what we call the cost of goods sold, or COGS. They literally have to factor in exactly how much they paid the publisher for the books before they can even calculate their gross profit from selling those books to us, the customers.
Bringing us to Section 4, the single-step approach.
For those service-based businesses we just talked about, we use what's called the single-step approach, and it is wonderfully simple. Step 1, you just list all of your revenues together in one big group. Step 2, list all of your expenses together in a second group.
Step 3, subtract the total expenses from the total revenues. And boom, the resulting number is your net income. That is literally it. This method makes absolutely no distinction between your core operating expenses and your non-operating items. It just tosses all the positive numbers in one bucket, all the negative numbers in another, and finds the difference. If you think about it, this operates on the exact same logic you used as a kid calculating your allowance. You didn't separate operational costs from non-operational costs back then, right? You just took the $20 you got from your parents, subtracted the $5 you spent on candy, and the $3 you spent on comic books, and realized you had $12 left. The single-step approach uses that exact same beautifully simple logic. It's absolutely perfect for small businesses that don't have to worry about carrying inventory. And finally, Section 5, the multi-step approach. Let's see how this builds for merchandising businesses. You can think of the multi-step approach as baking a layered cake. Instead of throwing everything into one big bowl, we're carefully separating our operating activities from our non-operating activities. Now, you might be wondering, why on earth would a business owner want to do all this extra math? Well, because it provides incredibly detailed analysis for decision-making. By separating the costs directly tied to the product from the general administrative costs, an owner can see exactly where they're bleeding money or where they're making an absolute killing. It highlights the crucial details they desperately need to make better choices about pricing their items and managing their inventory. So let's enthusiastically cut into this cake and see how the layers build. Layer 1 is uncovering your gross profit. You take your total sales and you subtract your cost of goods sold. This instantly tells you if your basic markup is actually profitable. Next, we move down to Layer 2. You take that gross profit and subtract your operating expenses, stuff like rent, utilities, and payroll. That gives you your operating income, which basically shows how well the day-to-day business is running. Finally, for Layer 3, you add or subtract those other non-operating items. Remember that gain from selling the old office furniture or maybe paying interest on a business loan? That goes here. Once you do that final bit of math, you arrive at the very bottom line, your true final net income. And that brings us to the ultimate takeaway today. We've demystified the math, we've explored the building blocks, and we've baked the layered cake. So I want to leave you with this final thought. Think about the venture you want to start one day, or maybe the company you admire most right now. Which statement of comprehensive income approach does that dream business actually need? Does it need a sleek single-step calculation for a nimble service, or a robust multi-step breakdown to manage complex inventory? Understanding this isn't just about passing some accounting test. It's about gaining the vision to truly measure, track, and guarantee your own success. Thank you so much for joining me for this explainer, and definitely keep asking the right questions.